Hi guys, Ian Johnson from DriveSuccess.com. Today we're going to talk about 5 simple, easy to use, easy to implement rules to live by, and these are 5 cash flow management tips. Now these apply to whether or not you're a small and medium-sized enterprise, a large corporation, it doesn't matter. These are simple and easy to use because they're all focused and predicated on saving money and keeping more money in your business. Okay, and you need to do that because it doesn't matter how profitable a given product or service is that you're offering. If you can't maintain a positive cash position, or if you have issues with financing and capital management, then you're going to have issues overall in long term. Okay, so the first thing we're going to talk about is leasing capital expenditures. Now, leasing capital expenditures, it's very simple and easy to understand. What you're doing here is you are renting things you should never buy. And we're borrowing from personal finance here. When it comes to personal finance, an essential rule in terms of managing capital, your own finances, is you buy appreciating assets. You buy things like real estates and homes because they go up in value. They appreciate in value. Okay, so they go up. And even though the most recent global financial crisis of 2008 and 2009 saw a dip, overall, the trend in history has always seen real estate go up. So you buy appreciating assets. You lease depreciating assets. You lease cars and things like that because they go down in value. So in business, you lease capital expenditures. You lease equipment, you lease machinery, you lease computers, laptops, cell phones, lease. Leasing keeps more capital in your house, okay? In your business. So you got more capital in the business. Okay, so you're going to keep more capital in your business. The other thing that you're doing, when you lease a capital expenditure, okay, you're basically depreciating the capital asset, okay? So when you depreciate the capital asset, you're actually taking a tax deduction, depreciation of capital asset. All right? So in this case, you're reducing your revenue on paper only, okay? So you're lowering your revenue on paper because you're depreciating the capital asset, you're lowering your revenue, and you're reducing your tax burden, okay? So essentially, when you lease a capital expenditure, you're basically allowed to take a tax deduction for leasing that capital expenditure, okay? Or for leasing that equipment or what have you. The second thing I want you to do is I want you to combine conventional financing, which is a bank and a credit union, with alternative financing. And this is asset-based lending, okay? ABL. Now, a link just popped up above my head. This link is going to allow you to compare the cost of financing through a bank. When you finance through a bank, whether you're financing an industrial finished good, you're financing the cost of goods sold. When you finance through a bank, you finance the cost of goods sold. When you finance through an asset-based lending firm that offers you things like purchase order financing or receivables factoring, you are financing the upfront capital advance they give you on the value of your open invoice. Okay, so having all, different financing options is essential to managing a cash position. The alternative financing options, asset-based lending, it's a little bit more expensive, but you're basically selling your invoice. You give your invoice to a financing firm, and they say, okay, great, we're going to give you 90% up front of the value of that invoice, and we'll collect from your customer for you. Okay? So I want you to combine conventional financing, banks and credit unions, with alternative financing solutions. Okay? The third thing I want you to do is I want you to incentivize your customers to prepay. Okay? Incentivize prepayment from customers. Now, if it's getting 20% up front or 50% up front, either way, either one of these things is good. Do whatever you have to make that happen. Throw in something from dead stock that hasn't sold in inventory for months. Give them a price reduction. Asking or incentivizing your customers to prepay, make sure you get more cash up front. Okay? It means you avoid the high costs of receivables financing. It means you don't have to wait 30, 60, 90, or 120 days to get paid. So incentivize prepayment. Give your customers a reason to prepay. The fourth thing I want you to do is I want you to pursue uncreditworthy customers. Okay, now most people are probably watching this video saying, why would you want to pursue uncreditworthy customers? Well, there's a simple reason for it. Okay, uncreditworthy customers have to prepay. They have no choice, and they know it. And most companies avoid these guys like the plague. They won't go anywhere near them. They don't want to deal with customers that can't secure credit. But for a company that needs to better manage its cash flow, these customers are ideal. Why? Because they have no other choice but to prepay. Nobody focuses on them. Nobody wants to touch them. And you can get cash right up front without even starting to manufacture, without even buying the raw materials. You tell them, yeah, we'll make the product for you, but you got to prepay 100% right away. That is fantastic because your gross profit on sales is going to be higher with customers that have to prepay than for customers that have to wait 30, 60, 90, or 120 days. Who knows? You may be even you may be able to charge them a surcharge. Okay. Finally, the last thing I want you to do is I want you to take advantage of your cash position. And what this means is your positive cash position. Okay? When you're in a position where you've got a lot of capital, I want you to prepay your own invoices. Okay? Get net 10-day net 10-day terms with 1% discount. Net 10-day terms, 1% or 2% discount. Okay? Negotiate a price with your customer. And once you've locked in that price, I want you to go back to them and say, okay, great, thank you for the price. Now we want to prepay. What are you going to give us off? 3%, 4%? Nail them to the wall with things like that. And the reason why I'm saying that you want to prepay is conventional wisdom is, well, no, if you should try and get next 60-day terms or 90 or 120-day terms because you keep more money in your business. That's true when perhaps cash flow is tight. But when you've got a lot of cash on hand, I want you to secure savings. Proper cash flow management is all about saving money. It's all about keeping more money in your business. When you have a positive cash position and you can negotiate better payment terms with your vendors in terms of saying, hey, we can prepay this time, you're going to give us 3% off, you're saving 3%. 3% is staying in your business. Hey, we're going to start paying you within 10 days. You're going to give us 2%. 2% more of your cash is staying in your business. So, number one, leasing capital expenditures. Lease computers, laptops, all these things, keep more capital inside of your business. Depreciating a capital asset reduces your revenue, reduces your tax burden, you get a tax deduction. Number two, conventional financing with alternative financing options. It's ideal. Check out that video. The third thing, incentivize prepayment. Give your existing customer base a reason to prepay. And give, hey, prepay 20%, we'll give you this extra thing in inventory we haven't been able to move or whatever, okay? Or prepay 50%, we'll give you 5% discount. Whatever you're doing, you're saving money on avoiding the high costs of receivables financing. Number four, pursue uncreditworthy customers. Nobody's touching these customers. They're there for you, okay? And you save a lot of money and you make more profit per sale because they have to pay up front. And take advantage of your cash position when it's positive. Get those discounts from your own vendors whenever you can. So that's it. 5 cash flow management tips. Ian Johnson, drivesuccess.com. Bye-bye.